Okay, let's get started. Yeah. So let's get started on the session. And thank you all for coming and for waiting patiently. It looks like it's raining and people are still kind of trickling in. So I'm Girish Shrimali. I lead the transition finance research at the Oxford Sustainable Finance Group, which is the kind of the organizer of this conference. And my work is on climate financial risks, on transition plans, and also on cost of capital. Before we get to the panel, I also wanted to mention a new initiative that we actually started a while ago, but this is actually the formal launch. And this is about a center on transition finance, a specialized center on transition finance. And in case it's not clear, what does transition finance mean, right? It's essentially financial products and services that support counterparties like companies, sovereigns, and even individuals to realize alignment with environmental and social sustainability. And given that within the global context, given that India plays a key role, both in climate mitigation, given that India is the third largest emitter now, and on adaptation, given that India is exposed to physical risks to a significant extent, we decided to launch an India-focused program called the India Transition Finance Program. And the idea is that as an academic institution, we want to provide best practice data and analytics on various aspects of transition finance, which is what I mentioned already, with focus on India. So the basic idea is that a significant focus of this India Transition Finance Program would be on financial intermediation, essentially what we call greening the financial system, which is to how do you get the financial system or the financial sector to think about sustainability and kind of move capital towards sustainable activities. But in the process, given the complementary nature, we'll also look at what we call financing green, which is how do you finance green activities. So we plan to do it in this program using obviously research, which is what we do as the group, but also education and capacity building, and we plan to do it through collaboration. And we have, as I said, that there is some work on India already. There's a web page that exists called the India Transition Finance Program, where you can find some of our papers. But this is kind of the formal launch in this conference. So coming to the panel, we have a kind of many distinguished panelists, and so I'm not going to spend too much time talking. What I'm going to do is I'm going to just introduce what we're trying to do in this panel, and then I'll ask questions that are potentially directed towards one or more. So as I have said already, that India is very uniquely situated, given kind of being at center stage in both mitigation and adaptation. And on the other hand, India is still developing, right? And so it has to kind of, it's a balancing game for India, maybe more than many other countries. So what we are doing here in this panel is we'll examine the sustainable finance landscape, right? So with that, let's get started. But before I do that, let me just introduce our panelists. So immediately to my left is Dr. Dhruba Purkayastha, and he's the executive director at the Observer Research Foundation, which is also called ORF, Middle East. And Dhruba has about 30 years of experience in this field, so it's a very long-lasting. He has worked on financing infrastructure, he's worked on clean energy, public policy, and public-private partnerships. among many other things. He's currently visiting faculty at Indian Institute of Management, Calcutta. So I'm just kind of picking up a few things from his long and distinguished career. Until recently, he was a director at the Council of Energy, Environment and Water. And before that, he was the director at the India Office of Climate Policy Initiative, which is also a think tank where I have also worked before. And at CPI, which is Climate Policy Initiative, Dhruba started many initiatives, notably a project preparation facility, so you can ask him about that. It's called the US-India Clean Energy Finance Facility, as well as the Center for Sustainable Finance. He also currently serves as the chairperson of the Climate Finance Committee at the International Financial Services Centers Authority. It's IFSCA. So welcome, Dhruba. He's also working with Niti Aayog, which is the kind of the think tank for the government of India. Second, Sachin Nanda, who is towards the end. And Sachin Nanda is a thought leader and a seasoned strategist with a successful career in private equity. And now he's a trusted advisor to boards, founders, and organizations. Coming from India, he is deeply connected to India and he continues to work with India. And now he is the Director General of the International Center for Sustainability, which is based in London. And there he champions initiatives that align thought leadership, environmental stewardship, and strategic influence to drive sustainable progress. So welcome, Sachin. Next to Sachin is Mayappan Nagappan, who is a partner at Trilegal, and where he leads a market-leading ESG impact and climate finance practice, and he kind of combines transactional, advisory, policy, and litigation work. So it's quite a few things that he looks at. He has worked on many notable initiatives in India. I'll just mention a few. He has advised on the first climate and agri-focus, which is agriculture-focused impact bond in India. He has also worked a lot on carbon credits. He has also been advising the government of India on setting up a focused green finance institution. So with that, thank you, Mayappan, for joining, and thank you for being here. Moving on to Mr. Kaushik Chatterjee, who is in the middle. Kaushik is the Chief Financial Officer of Tata Steels. He is the Executive Director, Chief Financial Officer, and a member of the Tata Steel board. And Kaushik was just in Holland. He's been looking at projects all over Europe, so I'm looking at him to kind of cover as to what's happening elsewhere, because as you know, steel is going to be a hard sector to convert into green products. So we look forward to hearing from you on what's happening elsewhere and what are the implications for India. So he has been instrumental in a significant project in the UK in Port Talbot. It's a 1.25 billion green infrastructure project in UK, and he is currently leading discussions in Holland for similar activities. He's been deeply involved in sustainability, ESG, and sustainable development goals. He's recently a co-chair of the Global Advisory Board of the United Nations CFO Coalition for Sustainable Development Goals. So with that, thank you, Kaushik, for being here. And finally, Ravindra, who is next to Dhruba. Ravindra Rathi, he is the head of International Corporate Development at Jindal JSW, and he has also worked in the City of London and focusing on energy and resources related matters. I met Ravi about 10 years ago, where we worked together on a currency hedging facility in India. And as you kind of talk about India and many developing countries, and a lot of the stuff we talk about is going to be common. you'll see that one of the major risks to investments, especially by foreign investors, is the issue of currency risk. So how do you create mechanisms for dealing with currency risk is what we work together on, and he can tell you a little bit more about that. So with that, let me get started. So the idea is as follows. I'll ask a bunch of questions, and I'll kind of direct the questions to individual panelists. And then after my questions, we'll move on to the audience questions. So that's the plan. So let's just start pretty high level, right? Not many people perhaps know about what's happening in India. So starting with a very high level question on what are the investment needs for mitigation as well as adaptation, right, in India. Where could the capital come from? Because there's a needs question as to how much do we need for whatever targets India has or whatever needs India has. But there's a question about where would the capital come from and where do we see likely gaps, right? So it's essentially a question around amount of capital needed. So maybe, Dhruba, do you want to start on that? Yeah, it's on. Yeah.
Morning and thanks. Very pleased to be here talking on India transition. So with this panel, I guess we have lawyers, we have industry, we have private equity also had, and my former colleague Girish. So kind of starting off, let me just start with first the world and then come to India. When we look at climate finance, and I think most of you would be aware that there is a number which the global fraternity, whether it is in COP, whether it is in G20, all of these forums, they talk about 4.5 trillion, 6 trillion incremental investments required globally. Climate Policy Initiative is an institution which has been tracking climate finance for a decade or more for that. And it is quite clear that the world is not investing that much in climate. And that is a global landscape report which is pretty famous. It's done also for large countries like India. So I'll come to that. Now, when you see that number, 6 trillion, and you see 1.3, 1.6 trillion being met, you can get a sense that, look, 25% of what is required is being met or being invested, both in adaptation. India is not, again, very different because the needs in India are about 160 plus another 60 odd billion, so 200, 220, and when you find the same tracking and the same methodology talks about roughly 50 billion getting invested annually. So the world is also doing 25-30% of what is expectedly required, and India is also doing 25-30% of what is required. Now let me come to where the crux of the problem both in India and globally lies. And it's important to recognize both the global and the relationship to India and understand that it's not very different. The world is about a 100 trillion economy. It has a savings of about 13%, financial savings. Now, if you were to consider the world to be an economy or a country, that incremental investment of another 6 trillion or 6% of the overall global GDP is not possible because it will not happen from, I'm wearing my economist hat today and trying to talk about saying that the savings and investment will not translate into that level of investment. So what we are seeing in the world is a gap, and that gap cannot be met. It can be met if one were to look at the stock of capital. The stock of capital globally is in excess of $200 trillion, and that is the GFANS initiative that needs to shift the capital stock, which is what we were discussing yesterday. So India is also in a similar situation. If you look at India, and if you look at the need for $200 billion per annum, an economy of 4 trillion size with financial savings bordering around 15-18%, and the rest of it goes to gold and real estate, that also will not be possible to be met from this operation of savings to investment and incremental gross fixed capital creation, because most of these investments are infrastructural in nature, renewable energy storage, hydrogen, grid connected, wind and solar combination, whatever you take. Now, therefore, the need is to move the stock of capital which is there, is the stock of savings, which is what rests with the asset managers, with the asset owners, the mutual funds, the employee provident funds, the pension funds. That accumulates to about 2.5 trillion. Now, that is what the question is. The question is, how do you, as Girish was talking about, enable more green finance from what is currently getting saved through the financial intermediation? And two is, how do you shift a share of the stock of capital which is lying into coming out of where it is invested in, let's say, high carbon intensive assets, to be able to move that. Now, in moving these levers, there's a lot more. I'll just end with the magnitude and the numbers, then Girish, we can come into how this shift can happen. And this shift is critically important because in terms of what we were discussing, if those of you were in the last session yesterday, is a question of how do I shift these global savings, the domestic savings, considering it globally, considering it domestically, this shift needs to happen. And that is, for a developing country like India, even if you do that, that is not enough. Therefore, capital needs to come from outside. And where capital needs to come from outside, there are these friction costs of regulation, laws, enabling foreign currency, lending, foreign instruments. There are financial services center. We can talk about all that.
Yeah. Thank you, Dhruva. So any other views on the kind of the investment needs and likely gaps before we move on to the next question? Any other views besides Dhruva? Do you want to?
Can I just
Yeah.
dovetail in on some
Okay.
of what Dhruva
Yeah.
said? I think from a, and they're definitely the needs of India, but let me flip it the other way. What are our needs here and in the rest of the world? Which is that, India, to my mind, maybe along with Brazil and Indonesia, maybe, are the only really major economies, developing economies, that have the capital absorption capacity, right? To put money to work and to potentially provide the kind of long-term yields that this money requires. Now, what's happening is that money, as Dhruva rightly said, is not finding its way into India, nor really Brazil or Indonesia, anywhere else. And so what's happening is that money is floating around within the OECD countries, let me be even more specific, predominantly the United States and Europe. And so what we're getting is, and I saw this as a person who spent a third, maybe more of his life fundraising with LPs and pension funds and so on and so forth, and I can tell you that there are asset bubbles being created all over the Western world, broadly speaking. And those asset bubbles that are meaning that we are exchanging assets internally where we're getting short-term returns are never going to be enough to provide the kind of returns that this capital is looking for in the sort of 25, 30-year span. So what we've got is a problem on both sides. The developing countries, India in this case, that needs the capital and can do something with it, and if we get the plumbing right, it can give us decent returns, isn't getting the money. And on the other side, we're creating asset bubbles on this side, which also means that essentially at the end of it, we're also going to be left short. So there is something to be fixed here, I think, and it's an interesting time and space to be in. And those who can solve this plumbing issue and get the optics right and then the systems right, I think there's a lot of upside to be had here.
Okay, so that's kind of a good point to kind of start moving towards. So we kind of talked about the investment required and the kind of the gaps and who could be potentially investing. But then that kind of brings up the question of what are the issues, right? What are the barriers to investment? What are the risks that investors face? So maybe could we spend a little bit time talking about these barriers and risk issue as investors look at India, whether these are domestic Indian investors or even foreign investors, what kind of barriers and risks they're looking at? Because if you just step back, and as you correctly pointed out, that India has the capacity to absorb capital. India also has a reasonably well-structured policy environment, right? We haven't talked about it much, but we can get into it when we talk about some of the solutions. So what kind of barriers and risks did you see? So Sachin, maybe can we get started on that?
Sure.
Yeah.
So to my mind, you used the word, I think, Dhruva, institutional frictions, right, that exist. Essentially, historically, the problem has been that India has been incredibly opaque and unpredictable, right? And capital loves stability. Capital loves predictability and transparency. And traditionally, that's not been the case in India. That's one. That is changing for sure, and I'm sure we'll dig into that a little bit further. Second thing is, again, it was touched on, which is when you're thinking about long-term, whether it's green energy or infrastructure projects, whether it's airports or roads, you're talking about 25, 30-year sort of yield timelines on that. And currency deflation there, the deflation aspects of the rupee. I mean, if you think about it, it depends where you draw the line, but if you look at the last 10 years and you take an average, the rupee depreciates between 3 and 4% per annum. So if you're an international investor, that's going to hurt you over the long term. So again, that can be overcome, and I think there's lots of work being done in that space as well, which I'm sure we'll explore. The other side is look, I think traditionally what's happened is external foreign investors want sovereign guarantees, which ain't going to come like they did in China. And on the other side, the Indian side often expect heroic risk-taking to take place as well, which is also not going to happen. And so in the middle, what we really need to do is build mechanisms that provides clarity, consistency, and stability, right? The thing about India is, of course, it's complicated because you've got federal systems, you've got state systems, and then you've got political instability where one party leaves, the other party comes. Are your contracts still going to go through? Now, it's got better. It's absolutely got better, but the optics are kind of behind the curve. As India improves, the optics haven't caught up yet with a lot of that. So a lot of investors I speak to have some of these concerns. The other side to this is, I think, on this side, so that's the kind of challenges India faces, but on this side, I spend a lot of time on investment committees. And we use certain types of models to assess risk and to price risk. And I've come to the opinion that a lot of our models are really not suitable. And let me just be more specifically for India. Because these models give a risk premium to India. But there is, in my argument, there is no India. There is almost 3 Indias that you're talking about. There is a 21st century India out there, which is 300 million strong, which has all the policy frameworks, all the transparency, stability systems. It's a very much a cosmopolitan India out there. But then there is a 20th century India, which is about 400 or 500 million strong, which is your first generation of Indians who are getting they're accumulating assets, they're aspirational, they're first generation of getting educated, degrees, masters, PhDs, and but yet they're still just coming out. They're only a generation away, just out of rural or those kind of opportunities have never existed in their families or in their lives. And then of course you've got 400 million Indians who are still, I would say, are in the 19th century, both not just socioeconomically, but also, in terms of the societal structures and the social structures there. Now, when we think about India, what are we saying? What are we talking about, right? When you build a 6-lane superhighway, and India is doing a tremendous job of building these highways, it's incredible the speed at which they're coming out at. those assets are going to be what the 20th and 21st century India really wants. They want to get on in life, they want to build, they want to develop. But there's a large swathe of the Indian public which don't own a car, won't own a car in the next 20, 30 years, or at least next 20 years, and are thinking, what am I going to do with this 6-lane highway that's just now cut across my land that I now need to go 40 kilometers round to get to the other side, right? So there are these stakeholder challenges there that do need to be resolved and fixed. And so when we think about risk, I think one single premium for India doesn't work. I think one has to get not just project specific, I would say we need to get platform specific, right? There's a great case study on that. Again, we can explore it, I'm sure, in this panel. Some of you will be familiar with it, of course. It's what Brookfield did, right? They went in there under renewables, and they didn't just invest in solar, they invested in the entire supply chain, and they invested in multiple green energy platforms. So if we can go into platforms thinking and then risk the platform, that's going to be a very different risk premium. And I suspect it's beneficial for both sides. So I think there's some work to be done on this side too. So I'll just leave it at that for now.
Yeah. Anything else from the rest of the panelists on the kind of the risks and the barrier issue? Kaushik, do you want to take it kind of a... Yeah, I think it's on, so you can just start. Yeah.
Thanks. So if I can bridge the earlier question and this one.
Yeah.
So one is the point on our absorption capacity as a country. I think the physical absorption capacity of that capital does not exist because the financial flows can come in, but just to talk about Sachin's Three India, the Three Indias are needed to run in some speed, may not at the same speed, but at some speed to absorb it on the physical side. Because if you look at where does the rubber hit the road, it's on the ground at the local panchayats, the blocks, the states, and Delhi is far away. Okay, so then when you start putting $1 on the ground, Dhruva talked about friction cost, it's significant in terms of the timing. We've improved a lot in the last decade, but the timing to flow that dollar onto the ground still takes fairly long time. And one thing that capital hates is delays, because it is spot jogging and not earning anything. So you got to get the broader architecture correct in terms of the speed at which you will absorb that capital. Second, when you look at large-sized physical build-ups, yes, we are doing 6-lane highways, we're doing coastal roads and mass transit projects, but the availability of skilled people is a concern, and it is a concern because of the Three Indias. The 2/3 of that India doesn't want to do that work. It's left to the residual 1/3 to take up as a Hobson's choice, then to have urban migration, poor living conditions, and executing projects for the 2/3 of India. So I think that is the issue that we face in terms of absorbing the capital. You can direct the capital, you can create policy framework, but the foundation has to be much stronger to accelerate the speed at which it can happen.
Thank you. Mayappan, do you want to kind of address this issue of risk and barriers in the projects that you see? Yeah.
Sure. Thanks. That's great to be here. And just to couple of points, what the other speakers mentioned on some of the other questions, I'll probably start with a few observations on that as well. So as part of the National Green Finance Institution work, we kind of looked into the numbers and had a slightly different perspective I thought I wanted to add as well. which is one, I think there are different numbers out there. I think Niti Aayog is working on India-specific numbers at this point, but just looking at the requirements, I think it was about $1 trillion required before 2030, perhaps, to, and the requirement for the capital is more today. It's not like you need it in a staggered way. You need like half of it today and then the other half, because the capex investments have to happen today and the opex costs go down over a period of time. And I would say half of that was projected in the infra, renewables, greening the power systems, and the rest was, I think, was also modeled in being required for like investment in technologies, because adaptation is kind of that's the other part where we thought the money is required, and what we're seeing anecdotally from companies as well. So keeping that in mind, I think we were looking at what the barriers to the capital were. So why isn't, and in fact, interestingly, one of the examples we took was if Tata Steel had to decarbonize a steel plant, how easy would it be in India or would it be outside of India in terms of raising capital? And what we got from stakeholder feedback and others was that it's a 5% return on equity expectations if it's outside of India, whereas if it's India, it's a 17% return on equity expectation. And we said, why is that sort of difference in the expectation? And that seems to be the different risks that are being factored into it. So it could be project risk, currency risk, regulatory risk, tax risk, and sort of that goes up. So if we have to start off seeing these as barriers and trying to solve for each of them, right? So you need sort of regulatory certainty, you need currency, you need sort of mechanisms to, as Sin said, for hedging the currency risks, etc. Now, just purely on the legal and regulatory side, I think some of the barriers are lack of coordination, lack of clarity in terms of policy signaling and in terms of enabling these financial flows. I think there is capital that's interested and willing to come in, but legal is always a challenge. It can be a great enabler, and I think there's been a lot of investments from the efforts from the regulators to improve the regulations, and maybe we'll get into that in a while. But currently, it is still something that acts as a significant barrier in terms of enacting transactions.
Cool. So we've kind of heard a little bit about risks, about the absorption capacity, or perhaps you even gave an example of a steel plant, right? So maybe I make this question more specific. If I were to ask, I guess, either Dhruba or Ravi, thinking about a project, whether it's renewables, whether it's green steel, if you were to invest, on that particular context, right? So now you're talking about either a solar plant or a battery storage plant or a green steel plant. What are the top 3 risks that you see? I don't know. Ravi, you want to take it, or Dhruba, you want to start?
All right.
Yeah.
Good. I mean, the risks that you look into when you invest in any project are pretty similar. Firstly, obviously, the technology. Whether the technology is feasible. There's a lot of excitement about green steel, hydrogen, electrolysis, some kind of chemical-based solutions, but none of them have been proven, or at least economically proven to date. So first one is technology. Second one, obviously, is the financing. What is the appetite of the financing entities to actually realize the physical dream that you have of that particular project? And third one is, again, it goes back to the skills. Do you have skilled individuals, both in the project management and the detailed execution of a particular project? So those are the kind of things that you would look into. But if I may, I'll try to just go back and dovetail to various strands that have been discussed. And I'll start from sort of basic principles at a higher level, and these are 2 strands, and then I'll connect them. So the first one is, we're talking about large-scale capital deployment in renewable energy, in greening or decarbonizing industry in India. So these are heavy capex projects. So we're talking about large-scale capex projects. Now, on every capex project, 75% is debt, 25% is equity. So essentially, if you distill it down, you are talking about the majority of the solution has to be how to mobilize debt capital for the financing of this infrastructure, climate infrastructure in India. That doesn't mean that you ignore equity, but I'm just laying it out there. So let's focus on the bigger part of the problem. Now, on the debt side, your suppliers are limited to Indian banks, some NBFCs, and maybe a few DFIs, but that's just peanuts. There is almost zero or next to nothing participation from international institutional investor on the debt side in India. And there are multiple reasons for that, and I'll come back to that, but I'll leave this strand here, that there is a massive requirement of debt capital. So when we talk about climate infrastructure capital deficiency or requirement, we should always qualify it by saying that there is a massive infrastructure local currency debt requirement. Now, local currency, I couldn't help but add it on because it's very simple. All your offtakes are in local currency, and it'll be unfair to pass on the owners of these projects to take currency risk when your revenues are not in that particular currency. So that is one stream. And then I go back to the bigger picture in the world and sort of, since industrialization for last 225 years or so. Where does this trillions of capital in insurance, in pension funds, or foundations, or family invest come from? Okay? Let's think about it. This infrastructure was built throughout 19th century in Europe, in America, in Australia, much of it based on capital that's been absorbed from colonial countries, from colonies, significantly from India, above all. And that's how that capital has been created over a period of time and generated, and now it's lying there. Now, in countries like India and other countries, so I take India as a proxy for broadly emerging markets and developing world. India is basically building the infrastructure that the Western world built in the 19th century, starting from sort of, we've come far, but there's so much to go, and when you, as Kaushik said, when you go to the municipality, when you go to the panchayat, that last road, that last public utility, that last, healthcare facilities, there's so much to be done. You're almost talking about building a new country, almost. When you're building that infrastructure, it's the principle of equity that you have to think as well. Which investor is going to make return from that infrastructure build out? In 19th century, 20th century, it was the Western world and the capital assets that were created in the Western world, primarily around individuals and corporations, and then subsequently into institutions like pension, asset, and endowments, and so on and so forth. The question is, do we give those endowments that pool of capital which is sitting outside India and which is always on the basis of risk-adjusted return, looking for higher returns, the opportunity to take more returns when India and other poor countries build this infrastructure out, or should they be participating in slightly lower return, but on a risk-adjusted basis, very rewarding return on the debt side? Because in debt side, there is significant capability to deploy. You can deploy it on refinancing itself. So, looking at it broadly, the loan book of banks, local currency banks on renewable infrastructure in India, I estimate it to be about 120 billion or so. Even if you refinance half of that, that's 60 billion, that's sizable opportunity. On risk-adjusted basis, now I know that currency depreciation is an issue, and Girish and I, we designed a solution, and that solution is not just on paper, it actually works, and we can try it out, and it's waiting for institutions to look at and sort of take it forward. But with those kind of solutions, you can still give decent returns on investment-grade projects to Western pension and insurance funds. So you're talking about 5.5% dollar. That's not a bad return for a pension fund which is just looking for yield, but not high risk. So there's no risk here. Most of these projects are, let me qualify. That's not the language of a finance professional. There is very quantifiable and something that you can absorb kind of risk in these projects, because most of them are investment grade. If the off-taker is SECI, NTPC, or state government discoms like Gujarat, then this kind of return is not too bad. The question is why it's not happening. And why it's not happening is a secondary discussion. So I just wanted to bring these two strands. One is that the institutional investor, the large pools of capital which have been generated at the back of the colonial economy for last 2 centuries, should now come forward to help not just emerging countries, because it's a question for Western world and the whole world. It's about saving the planet. They should come forward. And I'm not saying that this should be structured through grants. I mean, there are some people who argue that it should be structured purely through grants. No, but you should be able to look at the opportunities in the capital spectrum and be satisfied with the returns which are reasonable and which also are equitable. And the concept of equity in climate infrastructure built out is sort of one of the core principles that we have to look forward to when we take it further. I'll stop at that.
Do you want to add on to the risk issue? Yeah. Okay.
Can I just add on to the risk issue coming from, and I'm sort of focusing where Ravi left, Kaushik also alluded to. What I'm talking about is foreign capital debt not going to India. By the way, if you look at India's green investments or climate investments as it is measured, 85% is domestic sources or more is domestic sources. So we're not getting capital from outside. There may be some equity investors who are incorporated developers, but otherwise it is debt is not coming significantly from outside. Now, the problem is, what is the risk? Now, I know this is recorded in some ways, but see, I am wearing a policymaker's hat because it's important to wear this private sector, there is lawyers. The question is, you need to reduce, and something which is Girish's favorite, you need to reduce the cost of capital from as it comes into developing countries. India as a proxy for developing countries. LSE and along with IEA run a cost of capital observatory, and you can look at the data of kind of cost of finance for developing countries. India is not that bad. Argentina is at 44%. India is somewhere around 14, 16, 15%. So, but if you are alluding to the point that climate is a socialized global public good, I'll give you the contradiction here before I come to the risk of India. You know, the potential for renewable energy is within the tropics, where radiation is high, where land is available, but renewable energy investments happen outside the tropics. There is, if you look at the countries within the tropics, you will not find. So what is happening globally is the potential for getting the world to net zero lies within the tropics, which does include India, Indonesia, some parts of Brazil too, but capital and technology lies outside and it stays outside. So it's not an India problem, it's also actually a developing country, global south problem that capital is and technology is not moving across. From the Indian side, there are, as capital crosses, first we face a sovereign risk. We face an issue of sovereign risk, and then that, as Girish's question was, then you get into within the country to look at a project risk, which has its own typical project risk of technology, of completion, of contracts, of political risk, of regulatory risk, which is inside the country. But we are missing one thing with that. Here is the question that the risk, see, it's very difficult to explain to an Indian policymaker that you cannot mitigate the risk of India from within India. India is the risk. So for the foreign capital, India looks up as the risk. So for the policymaker in India, when you try and explain, well, literally you have to tell you are the risk, so you cannot mitigate your own risk. And herein lies the problem, because that takes away 300 basis points for any capital which crosses. And then we are adding on to other risk premiums. Now, mitigating the risk is important. But this part of the risk, I mean, I can wear one hat while saying India shouldn't be a triple B country and India should be this, India should be that, and we are doing well and it's high growth and we have never defaulted. That's one story. But then that doesn't work. That pitch does not work. Pitch does not work for capital, but the capital is then bounded by those ratings. Capital is bounded to follow those ratings, whether it is in Wall Street or whether it is in London. They are looking at, I happen to be ex-IFC, and as I looked at pricing a project, moment you put on the tool, moment you put in an India project, the rate goes up by 250 basis points. Now, that is, cost of money is extremely important for hydrogen, for renewable energy, for storage, because it is not the material and operating cost, it's the cost of finance that defines competitiveness, defines what you produce. And if you are able to, it's asset intensive, it's an asset that you are creating, and that's the cost of money. So this cost of money and this capital, yes, there are India friction costs, but this will need to get addressed from outside the country in some way. So that's, I happen to sit on Global Green Guarantees Group, which is getting constituted, and they are currently working on saying, how do I reduce the cost of money by guarantees to developing countries?
Okay. At least hopefully that gives you some sense of the barriers and risks. Obviously, it's not comprehensive, but kind of there are country-specific risks and then there are project-specific risks, and we're kind of dealing with all of that, and a lot of us work on these issues as we go along. So just to kind of move the discussion forward and talk a little bit about solutions, I would love to kind of get a kind of perspectives on, obviously investors are facing barriers and risks, whether these are international investors or whether they are domestic investors, right? But if we could talk a little bit about what are the solutions that are out there that are being developed and that are being kind of deployed to kind of move capital and kind of get a sense of how well they're working. So maybe we start with Mayappan first and then go to Kaushik on that.
Sure. Thanks, Girish. I think I'll probably also speak a little bit about the legal and regulatory side of things first and then get into that. And some background facts I wanted to add also to the India context in addition to what Dhruba set out. I think what we see is that in terms of COP29 afterwards, the lack of, there's not much sort of capital expected to flow from that front. And in terms of the private capital side, I think what we are looking at in terms of interest, in terms of stakeholders, is that the funds are quite keen to invest in India on the climate side. And what they're actively trying to do is reduce this cost of capital through a host of different mechanisms, including blended finance, including using guarantees or philanthropic money to sort of bring that cost of capital down and get into the more riskier sort of investments. So when I was speaking earlier about the capital requirements as well, one was of course the infra and that other speakers have spoken about, but the other end of the spectrum, right, the investment on the mitigation side, what they're looking at is these risky investments in technology where even an IFC will not go, because all of these institutions are mandated to invest in companies which are viable or close to being viable. So green hydrogen or some of these experimental technologies are not seen as something which are investment worthy even for institutions such as these. So to try and, so there is one end of this, and there is no pipeline unless there is capital going into that end of the spectrum. And to bring the risk down, blended finance and funds are looking to solve some of these problems. But the challenges we face from a legal and regulatory standpoint in India, for instance, is we have multiple regulators. We have SEBI, which is the Securities Exchange Board of India. We have the Reserve Bank of India, which is in charge of macroeconomic stability and keeping the currency rates up. We have the international IFSC, which is the International Financial Services Center, which is a special economic zone and empowered authority, which is intended to make financing easier in India. We have the Ministry of Home Affairs, which is in charge of foreign philanthropic money coming in. We have the Ministry of Finance, which is responsible for things like how do we negotiate a treaty on carbon, should we set a carbon tax, and the overall sort of responsibility for financing the transition. And Ministry of Energy, for instance, comes in from a carbon credits perspective from a regulatory standpoint. What I'm trying to say is that there are different sort of ministries and regulators which have different mandates, and there is usually a lack of coordination. There is a challenge around the capacity in certain sort of ministries or regulators in terms of understanding how these things work on ground. And so for instance, IFSC may be something that's an empowered body, but sometimes they don't, and they have the mandate to bring money in, but then they do face challenges when, for instance, if you have to set up a blended finance fund, they do not have the powers to enable philanthropic capital to flow into India. That comes under the Ministry of Home Affairs, and that's an extremely politically motivated decision. It's the perspective around controlling that capital flow is different. When you look at domestic sort of philanthropic money for blended finance, you have CSR, which falls under the Ministry of Corporate Affairs domain. But then again, tapping that has also been difficult, even though it's in the fully domestic control. I think these are all decisions which there is no one institution or body which has been given the mandate to look at climate adaptation and has been empowered with the appropriate powers or technical capacity to kind of bring that in and spearhead any sort of technical work that needs to go into setting out these frameworks. So today we are seeing a very fragmented system. Each regulator is taking steps, progressive steps over the last year in trying to create some new regulations and momentum. But it's coming from their specific mandate. For example, RBI has issued a whole host of consultation papers in terms of greening finance, in terms of they're trying to look at, nudge banks to say that you need to put in capacity systems, you need to start measuring scope 1, scope 2, scope 3 emissions. But all of that is coming from the fact that the Reserve Bank of India is tasked with ensuring macroeconomic stability, and they're looking at climate risks as something that could affect that, right? But the perspective of a regulator is to control or regulate capital, not necessarily to incentivize or allow more money to come in. In fact, if more money comes in, it's more work for them. So I think there is a need for a specialized institution, and then there is a technical requirement, in terms of to be technically sound to be able to coming up with these frameworks. Because what the regulators have done currently is they've taken a very pragmatic approach at this point in time, which is to say that we will not come up with our own framework, but we will adopt globally established frameworks to at least attract finance, which is the right thing to do at this stage. And if we develop our own taxonomy or framework, then we can always include it. But I think having worked on impact bonds and on instruments which are extremely highly focused on predefined outcomes with money being tied to it, and all of this is on a spectrum. So to what extent are we actually giving, the integrity question, right, in terms of how are we assuring investors that these outcomes are actually being achieved? I think there are a lot of challenges there. So we have borrowed a lot, some of which has worked well globally in terms of metrics and standards, but I think there's a lot more work to be done at our stage.
Okay. Thank you. I wanted to, again, make the discussion slightly more specific, and again, before going back to Kaushik. So I know, Kaushik, you've been looking at green steel, right? And steel is, as I said, it's a hard-to-abate sector. If you look around the world, most of the focus has been on renewable energy, solar, wind, etc., right? And there is some focus on greening transportation, which is electric vehicles, etc. But we do need that. We know that the next step is trying to kind of decarbonize industry, which is steel and cement. And Kaushik, I know that you've been looking at steel and greening steel production in different countries, right? So you have looked at UK, you've looked at Netherlands, and you're also looking at India. It's an India-based company to begin with. So in some sense, going back to this point that was brought up before is of technology risk, right? I mean, you could argue that green steel and various technologies within green steel, whether it's electric arc furnace and using renewable energy to kind of feed into electric arc furnace, or even doing recycling, etc. A lot of the technologies kind of exist, right? And because you have these plants that are kind of working. So if you could kind of provide context on what's getting them to work in, for example, UK and Netherlands, right? And if you were to do the same project in India, what barriers you see? And then it's a kind of a longer question than that. And in terms of the barriers that you see, what kind of help do you need from the decision makers to kind of, as you were saying, my opponent has 17% expectation on cost of equity. Maybe you're not seeing that. So what would you need from the decision makers? It's the longest question, but love to kind of hear you kind of walk us through this process of how do we get more green steel investment in India?
Sure, thanks, Girish. See, first, let's start at the baseline. Any investment requires an investment case. And that investment case is based on technology, markets, cost structure, regulatory costs, and to go to the friction cost. These are all the
elements that get into the investment case. Now, in the context of what we are seeing across the world, there are geographies like the US, which incentivizes this transition, and geographies like in Europe penalizes, so there's a carrot and stick, penalizes through higher cost of carbon. And the moment you start pricing carbon, the investment case becomes different. Because, see, we don't, end of the day, much as what people would like to think as a part of corporate responsibility, unless there's an investment case, a low carbon migration is more a vanity value. So you have to have the investment case. What's happening in Europe, including in the UK, is this transition effectively is borne by three stakeholders: the community of the government, the company, and the customers. So these are the three stakeholders who actually help create that investment case and help create the transition. And when I say how do they help, effectively the three stakeholders pay for it. Okay, so that's the fundamentals of any investments. Now, when you have I'm specifically talking about climate, so not about nature and climate, but I'm talking about climate, which is effectively when you start. I remember in mid-2000s when the EU ETS had just come in Europe, the price of carbon used to be 7 euros, 8 euros. If you're using 2 tons per ton of, say, steel produced, it's about 15 euros. Its absorption is much easier. Over the last decade, it's gone up to as high as 86 euros. So 86 euros or 85 euros or 90 euros is 180 euros per ton of steel produced. That's not, the absorption capacity is not there. Hence, the trigger is you have to look at how do you work towards this transition. Why did this increase? One, because it was a market-led initiative, and it's very important to actually have this market-based pricing of carbon rather than a nominated price of carbon. And then you have the policy framework where the free allowances were reduced. So as the free allowances were reduced, the demand for carbon increased, the supply is limited, and therefore the price increased. That's very simplistically how the economics work. And therefore the policy nudge is basically get yourself ready for the next stage of sustaining yourself through the migration to a low-cost technology, or use the same asset base for a new technology, or adapt yourself to a new process. So the investment case becomes the most important thing. Now, when we talk about these three players, obviously the company or any corporate in any business has to see its long-term returns, as Mayapam talked about. So there has to be the underlying market, the underlying cost structure, the fundamentals of what you can do or can't do. Then the customers have to pay for it, because if you're talking about green steel or green aluminum or anything which is low carbon effectively, the customers have to pay for it. And you cannot expect the same price points pre and post. So there is a cost which has gone in. And to meet the investment case, what we used to call in India earlier viability gap funding, is what the government said, because my NDC goals are tight, I have to reduce 55% from a baseline in EU Fit for 55, or in UK, we're talking about getting to net zero. So therefore, I have to enable that investment case to happen. So therefore, you can structure it, whether it is a pure grant or a blended finance of a long-dated debt or a mezzanine, whichever works in making that investment case. So this is what the policy maturity has come to as far as Europe is concerned or UK is concerned, though I must say that it's on a softer pedal just now because of multiple factors. We can debate that through the day. But I think the fact is it is being more realistic because the target dates were 2030 looks very difficult. And the ecosystem is also not ready to do the physical absorption. Availability of contractors, the whole skills available, because this part of the world has also migrated to a more service economy. So the physical manufacturing, and that's why China has become the factory of the world, which is being relooked now from a European perspective. Now, in an Indian context, unless you have the first trigger, which is the cost of carbon, which the CCTS provides, the policy which is now being put up for consultation, provides the starting point, and I think the right starting point, because when you are looking at an investment case, there is this pricing of carbon which triggers one, and then like in Europe, you have, which is very hated subject in India, is the CBAM. Because you're essentially saying many people think it's a trade barrier, but if you look at it fundamentally, it's actually a carbon actualization process. What a domestic guy in Europe pays is the same price somebody else who's not paying for it has to. It's like a double taxation treaty in income tax. You equalize effectively. So when the policy framework enables that business case or investment case, the cost of capital automatically settles down to a level which is more competitive. Because the uncertainties go down, then it is a question of that particular borrower, whether they have a track record of execution, whether they can do what they need to do. Then the investment case framework changes very significantly. And I think we need to get to that zone, to Sachin's point that yes, India will possibly never give grants. To what my opponent said, that philanthropic money is effectively that. So instead of government giving it, somebody else is kind-hearted to give that money. So for different purposes. But you need a viability cap funding mechanism. You need a method where an external capital provider gets a guarantee mechanism for default. You need to have these safety nets. Once the safety nets are put in place, then you will automatically see that the cost of capital comes down, the flow of capital increases. I mean, there are huge amount of capital in the whole, what Drew has talked about is the savings across the world, which needs a safe capital, a safe investment, which will not be burdened by fluctuations in tax policies or the underlying business should not get through volatility of policies, be it industrial policy or any other policy. So I think if we focus our mind to say that there is a part that public infrastructure, the government will spend, how do we reduce that cost of capital? Because then the public utilities will be more viable, the speed at which you can do that. And secondly, for the private corporates across sectors, how do you create a better investment case, which then leads to more investments, reduced cost of capital, reduced risk, and it is not a few years story. It's actually almost like next half a century story. So you need to prepare the foundations and work on the ecosystem. The 1/3 India that Sachin talked about, the 19th century India has to come about. So you have to build skills, you have to ensure project execution, you need more coordination between states and center. While the states have given their state action plan on climate, etc., how do you follow it up? How do you actually do that? So I think that's how the solution set can work. If there is a coordinated approach towards both policy and resources.
Yeah, I wanted to kind of not just focus on steel. I thought it'll be a nice example. If you look at India and India's kind of story so far in getting to its climate commitments, a lot of action has been on renewables, right? We have, to the order of 100 gigawatts of renewables in India, which is one of the largest in the world, and we continue to build. And part of that was kind of driven by the ministries that were responsible. India had a separate ministry for renewable energy, which has now become kind of more official part of the Ministry of Power, right? So now it's been recognized that renewables are the main way that India will generate electricity, right? And so that's kind of, I would say, kind of a success story in some sense, right? So what I'm also kind of curious about is if we had to repeat the similar kind of, and I'm not saying that we have, achieved India's long-term targets on renewables, but at least there is a best practice in some sense that was driven by the Ministry of Power. Do you guys have comments on what could be done for hard to abate sectors like industry or transportation? Is similar kind of stories are being created, and if not, what could be done? So I don't know, maybe Ravi, do you want to start quickly and then we kind of go through the panel, because I think that's where it's going to be to a large extent as to what are the policymakers doing in the real economy, as well as the regulators that are sitting on the financial side, like the Reserve Bank of India, which is RBI, and the SEBI, which is the Securities Commission. So, Ravi, you want to start? Yeah.
So I think you're right. We look at the what's not been done well, and rightly so, but we also should celebrate what's been done well. So this transition to renewable, although we are still 200 gigawatt or more so away from the target by 2030, but still a sizable capacity has been built, and that's been facilitated by the state to a large extent. And I think that's a model that is to be emulated in other sectors as well. But I think the state's purpose, when you speak broadly, is in providing the raw material for a capitalist economy to actually function the way it ought to be. And in terms of raw material, these are just simply laid out issues. They are not new. You're talking about high quality workforce. So for that, investment in health and education, has to be critical. Reducing the friction, in terms of commissioning these projects, because many of them now need to move to smaller level, to municipalities, to block levels, and so on and so forth. At the moment, most of the initiatives are at central level. For a country which is size of a continent, it's very difficult to sustain that going forward when you kind of replicate it into other areas. So kind of decentralizing and moving it to sort of where it's actually needed. Those are the sort of areas. And then on the regulatory side, it's simple. Consistency, predictability. Those are the kind of areas that regulatory side needs to stay steady on and sort of maintain. My friends from Trilegal are more well versed with this sort of structural issues, but we get sudden changes, like in an AIF structure now. I don't know whether you could have tranches or you couldn't have tranches. Those are such basic issues that should not be coming up in these areas. And so policy predictability, investment in health and education, replicating the model where it's been successful at central level, taking it out to the smaller granular local blocks, district level. Those are sort of standard things.
Right. Thank you. Sachin, do you want to come in? Because I also want to kind of focus a little bit on kind of the transportation sector a little bit, and maybe hard to abate. And these are different models, right? Because a lot of the electricity transition was driven by kind of the Ministry of Power, obviously with the state's help. But you can see the transformation that's happening in transportation. It's mostly states-driven, right? So there are different models. But if you could kind of compare and contrast, and what are we learning from this that we can kind of continue to build on, maybe for hard-to-abate industry, et cetera? Yeah.
So I'm just going to, I agree. I'm just going to share two quick stories with you, right? So both of which I was heavily involved in. I was part of a group here that was going to acquire a large chain of private hospitals in India. And we never got through it for structural reasons rather than price points or anything else. But what I learned in that process, and one of the things that I think India does very well, and I think one of the reasons why renewable energies has done well, I think is to do with this. Is so just some numbers for you, right? So 2015, broadly, the price of renewable energy in India was around 7 rupees per kilowatt per hour. In 2021, it was 2 rupees. That's significant. And that's because the price of capital for renewables has come significantly down. Why? Because they did something really interesting. They created tribunal courts that were fast-tracking delays. So if I had an issue, the investor knew that actually within 90 to 180 days, my issue will be resolved. And what they did really well was that they had judges, the bench was trained to understand renewable infrastructure and renewable finance. They were trained in it. And that same process when it comes to infrastructure, so for example, bridges and airports and roads, they've got a tribunal court there, but the bench is not trained. The bench has no clue about how to actually arbitrate some of these issues. So India has done some things really well in some sectors and not so well in other sectors, healthcare being one of those, where you have a tribunal court which fast-tracks foreign investment delays or issues, but the bench is not trained. And therefore, you go back down to issues. The other quick thing around, I'm by all means, I'm not an expert on automotives or anything like that, but what I will say is, again, from a structural perspective, one of the things that India can do, and really I suspect will end up moving in that direction, kicking or screaming maybe, I don't know, but it's this blended finance model. To your point as well about, ultimately India has a certain time frame within which it needs to deploy this capital, and it's kind of front loaded. So again, how do you do that? One of the things that I sense that will happen is that global investment funds are going to create kind of blended finance sort of approaches to India with a longer tail. And so if you imagine the kind of deployment and the kind of returns, you're front loaded initially, but then you have a longer tail and that tail spikes up at the end, right? So this is actually being modeled as we speak. So that's quite exciting. From the automotive perspective and the EV perspective, I'll just come to the power grid. So one of the areas is India's done really well with renewables, and it's the 4th largest provider of renewable energy. It'll soon be the 3rd largest. It'll overtake Germany, I think, by next year or the year after, in terms of renewable energy. But it's got a long way to go. But the thing that it needs to focus on, and this is again a structural issue, is its storage facilities and its grid structures, which still need to be hugely, so in some states are better than other states, right? That's the other challenge with all of this. So again, if you can show the foreign investor that your delays, your land acquisition, your ability to deploy capital becomes friction-free or smoother, it significantly reduces the cost of those investments, and therefore larger amounts of capital come in. It wants to come in those spaces, especially around storage, battery storage, and grid upgrades. So I think there's something to be said about that. And my final point I'll just kind of make quickly is, I think when we think about the opportunities that exist out there, they are huge. We're talking about India needs, thousands and thousands of e-buses, right? So these are like kind of green buses, green transportation, smart logistics. So one of the things about India is, although India is the largest producer of grain in the world, it is also one of the largest wasters of food in the world, because it can't get its food from A to B in time. One of the reasons for that is it doesn't have cold storage, nowhere near the amount of cold storage that it requires. So again, smart logistics is another big area that I suspect huge amounts of capital will need to flow in. over the coming decade. And of course, somebody's already mentioned cement capture and greening steel, so I won't go into that. So I think these are some of the areas that are still out there to be captured. And I think there's some interesting instruments being developed in conjunction with reassessing our own risk models on this side.
Thank you, thank you. And so Dhruva, kind of the last we are kind of running out of time now, so maybe in a minute or two, if you could just take this question and wrap up. And I also want to ask you, do we have still time for audience questions? By a few minutes? Okay. All right, so let's...
Okay,
Yeah.
in short, your question is, what can be replicated in renewable energy? Starting point, okay. Yeah, Sachin was brilliant in kind of laying out all the issues, but let's understand, India needs to grow, reduce inequality, and decarbonize at the same time. It's not been done by any country anywhere in the world. Now, coming to it, renewable energy, success story. First is it's renewable electricity. Sometimes we always call it energy, but let's recognize that energy is just electricity is just 25% of energy consumed anywhere. So it's renewable electricity. Success story, yes, 200 gigawatt. By the way, day before yesterday, India met NDC, revised NDC, some 5 years before time. Now that's something to talk about politically, but well, goalposts can be questioned. Coming back to saying, is it a private sector success? No, it's a policy success. Renewable energy has not been done by private capital or the private enterprise. As a starting point, it was public procurement which created renewable energy in India. Because of public procurement, you had private enterprise and capital coming in. In an infrastructure business, private sector cannot get up one fine morning and build a road. So there is a public procurement, public policy, institution, projects. That's how I look at it. Policy, institution, projects worked right. What can be done for? So this is how decarbonization works. Energy, electricity, clean transport, then decarbonize industries. Hard to a bit. We can go to agriculture after that. So let's look at the same tools. The procurement which is happening on EVs, on bus transit. So there's public procurement on EVs which is happening for bus transit in many, and both our former colleagues are also running some enterprise to doing that, Mahu, as you well know. So there is an institution set up to do that, to create electric buses where bus transport exists, but diesel buses, they will get replaced. And there is also a question of mini buses or micro buses which are being replacing. You have intermediate transport in India because the bus transit does not cover most of the people. So you need three-wheelers, what you call tuk-tuks in Bangkok, or the three-wheelers which then service, they are electrified. You have forklift trucks, they are all electric. Then you have the third level. You have rickshaws which are electric, and then you have scooters which are completely electric. Then you need storage, because what you need is storage for electricity. You will see a transformation of retailization which will happen in India, is to say that every corner shop will be exchanging electricity with the grid. You are aware about Uniform Payments Exchanges in India, what's called the UPI payments, it's the Uniform, or I say Uniform Energy Interface with the grid, which allows the balance and the grid and the battery to be stored, apart from grid-connected batteries. So grid-connected batteries are also a public procurement on the steel. Yes, there will have to be, agree with Kaushik, there's a complete need for a viability gap funding, and the viability gap funding is projects put on table, if at all, but industry is more private sector and the government does not bring project to table. Therefore, procurement of green steel, because steel goes 35–40% is construction which the government procures. The industry will respond to incentives of viability gaps and subsidies, and that's the tool by which you will move the greening of industries. In addition, there is local carbon markets coming into play, which is in a way akin to EU ETS, but there are some problems in that because they're going plant-wise, you know that. I mean, it's a huge burden to define plant-wise standards, but we can go into that. So that's the third thing that will replicate these successes, but this is not capital, this is policy issues. And then what Mayappan explained, along with risk guarantees, along with blended finance, along with pooled capital contributions, ensuring that banks at least significantly lend, which is, India has a significant directed credit, it's called priority sector lending. Combination of these will make the transformation happen.
Thank you. Thank you. All right. Thank you, everyone. And I'm also realizing we're kind of getting close to the end of time here, but I wanted to take some questions from the audience. So we do have mics around. So if you have a question, please raise your hand. Also state your name and your affiliation, and please try to be brief. We have about 5 minutes left. So we'll take a few questions, and I'll also request the panelists to be brief in their answers. So where is the, yeah, okay. Maybe we have a question here. Yeah. Oh, over here.
Yeah,
all right.
First question is here.
Yeah, maybe we can club these 3 questions. There are 2 over there as well. So why don't you start and we club questions? Yeah.
Good morning, everyone. Thank you for having such a...
Introduce yourself.
My name is Kanishk. I'm a shaving scholar at the University of Edinburgh. I was a former consultant to Niti Aayog in climate finance realm. My question is, in terms of financing the India's green growth, would have been much better if we had a policymaker also on the panel, would have just elaborated a lot of questions on that front. But in terms of getting more money, so in digital space, there's a digital transition which is happening, there's a green transition which we are talking about. Digital transition generally gets better finance in terms of because they have real quick returns coming up, whereas the green transition is a much larger game to play. We have seen successes in Australia, maybe like IRENA or CEFC. We've been talking about developing an institution just for green financing, but how far do we see it from conceptualizing to actually creating, which doesn't conflict with the existing financial institutions? That's my question.
So that's your question about green finance. Okay, yeah, the next 2. Thank you.
Hi, Alice Delamere from the Sunrise Project. You've talked a lot today about the importance of debt and the capital coming from outside India. And I'm really curious to know your opinion on whether you think the US indictment of Adani has kind of raised the risk perception for bond investors, particularly from outside India. And if that perception is real and it has raised the risk, what do other companies like JSW, like Tata, need to do to distance themselves from that perception?
Okay, thank you. And the third question?
Sorry, Will Goodhart from the Future of Sustainable Data Alliance. And I think my question is a little bit like the first question, which is, I think, Mayappan, that you were talking about you're setting up or trying to set up an organization to try to make it easier for foreign capital to come into the Indian market. I think that's a very exciting idea. I'd like to learn more about why that is proving difficult to do, or if that is something that is going to be anticipated soon.
Okay, cool. So let's just try to structure this. I think there are 2 questions that are similar on this focused institution on green finance. So Mayappan, do you want to start on that, and maybe Dhruba, you add to that? And then there's a second question around this whole reputation risk issue, not only for Adani, but for the whole Indian market. It's like, so that kind of takes us back to Enron in 30 years ago kind of thing. So maybe we'll start with Dhruba on that, and obviously other panelists, if you have to add. So let's just start with Mayappan on this question of Green Finance Institute. Yeah.
Sure. Thanks for those questions. To be clear, I think Dhruba and I have also collaborated on that same stream of work separately. So I think on creating this institution, I think in current Indian context, they're trying to aggregate institutions, not necessarily create a new one. That's something you're going up against. The second thing is, the challenge is there are many existing institutions which already have many fractured mandates. So there is banks for agri, there is banks for small enterprises, there is the Reserve Bank which has the macroeconomic sort of mandate. So creating a institution, and we've seen a little bit of this with IFSC when it was given specific powers of RBI officially, but at the back end, they always exercise some controls. So create, and we already have other infra institutions like NAPFID, which is there for infrastructure. So there is a discussion going on as to can't we not just repurpose existing ones, but the main challenge we're running into is that the mandate is still too narrow. When you look at climate mitigation and adaptation, it is too narrow. And second is, it's not just about the financing and enabling new instruments or to lower cost of capital, it's also the technical expertise. And we've heard this from CPI, from others in India, that part of this is making sure if you want frameworks and to channelize the capital, you need the technical expertise also to be there. So perhaps if this has to become a reality, the path I see is where it doesn't compete with existing institutions or with existing private capital providers, and where it's able to sort of enable other existing institutions to raise and achieve their goals. And fill up the white spaces is where I would like to see this position, because we have the UK Green Guarantee Corporation. We don't have an equivalent of that today yet. So I'll hand over to Prabha.
And I apologize, we've been given the ultimatum to close, so I apologize that we have to close now, but thank you so much for coming. And if you have any remaining questions, please do come to the panelists and kind of have a one-on-one conversation. But again,
Tricky question.
Yeah, that was a tricky question, but I think it's maybe an offline discussion now, because I think the next panel is about to start. So thank you very much, and see you later.